Good morning. My name is Lin Zhang. I'm from Fox School Business, Temple University. Today we are going to discuss a very interesting topic, market efficiency. Let us first look at two investors. Both Investor 1 and Investor 2 want to invest in the stock markets. Investor 1 wants to keep his life easy and simple, so he decides to invest in stocks that are included in the S&P 500 index. However, Investor 2 is more hardworking, and he decides to carefully study past stock price and trading volume information and use that information to predict future stock price, so he frequently buy and sell stocks. Do you think Investor 2 can earn a higher return compared to Investor 1 consistently? Now we have a third investor, Investor 3. He's even more hardworking compared to Investor 2. He does not only study past stock price and trading volume information, he also closely follows any news about the firm, about stock on TV, on the internet, and also on the newspaper. And he uses all that information to try to predict future stock price. And do you think Investor 3 can consistently beat Investor 1? Now we have a fourth investor, Investor 4. He's also very hardworking, and also he has a lot of connections. He has a lot of friends who are CEOs and CFOs of firms, and he can call his friends to ask for some private information about the firm. And he used that private information to try to predict future stock price. Do you think Investor 4 can beat Investor 1 in the stock market? Back in the 1960s, there's a very famous financial researcher, Professor Fama from University of Chicago. He became very interested in the question we just asked, and he developed an idea called market efficiency. Market efficiency refers to the way information are reflected in stock price, or in another word, how stock price is determined by information. So depending on how quickly and fully information are reflected in stock price, we have two types of information. Two types of markets, efficient markets and inefficient markets. In efficient markets, stock price fully and quickly reflect information. In other words, stock price is correct on average. However, in inefficient market, information is not fully and quickly reflected in stock price. So sometimes maybe stock price is far from its underlying true value. So let's look at graphic illustration of how stock price reacts to new information in both efficient and inefficient markets. So for example, there's a firm have some good news at time 0. For example, the firm could announce some good earnings, and at time 0, you can see stock price goes up because of this good earnings announcement. In the efficient market, the stock price will go up instantly and then stay constant. So as an investor, you cannot make profits after you hear this earnings announcement, because after time 0, the stock price is constant. You cannot earn profit as an investor. However, in inefficient markets, stock price gradually adjusts to this good earnings announcement, and as an investor, you have the opportunity to invest after time 0. And for example, you buy the stock and hold the stock for about 10 to 30 days, and then you sell it when the stock price is at its highest point. You can make a profit. And the other scenario under inefficient markets is stock price may overreact to this good earnings announcement. So stock price gradually adjusted down. So those are the cases in the inefficient markets. So stock price reacts to what kind of information? Basically, we have 3 different information sets. First, we have past price and trading volume information. Those information are available to investors. For example, if you are interested in a certain company, you can find the stock price and trading volume information of the firm from Yahoo Finance. And then we have all public information. This first includes past stock price and trading volume information. And then it includes some other public information. For example, it may include firm's income statement, firm's balance sheet, firm's earnings announcement, or the firm's announcement of change of management team. And then we have even larger information set, that is all public information and private information. So it includes all public information and as a private information. So what is private information? Private information refers to the information that is only known to the insiders of the firm, such as the CEO of the firm, the CFO of the firm, or the directors of the firm. And that information is not available or not known to the other investors outside the firm. And that is private information. For example, if the firm wants to acquire another firm next month, this information is only available to the insiders of the firm, such as the firm's CEOs, and is not available to the outside investors. So this can be considered as private information. So based on these three different sets of information, Professor Fama proposed three levels of market efficiency: weak form efficient markets, semi-strong form efficient markets, and strong form efficient markets. And this is also known as the efficient market hypothesis. So according to the weak form market efficiency, stock price fully reflect all the past stock price and trading volume information. So the implication is that stock price will follow a random walk. You cannot use past stock price information to predict future stock price. So in this case, technical analysis will be useless. So if we have weak form efficiency, back to our beginning example, investor 2 cannot consistently beat investor 1. And semi-strong form market efficiency refers to that information, stock price reflect both past stock price and trading volume information and all the other publicly available information. And the implication is that publicly available news and financial statement information are useless because those information is already incorporated into stock price. In this case, fundamental analysis is useless. So if we have semi-strong form market efficiency, back to our beginning example, investor 3 cannot consistently beat investor 1 in the stock markets. Next, let's talk about strong form market efficiency. In strong form market efficiency, stock price not only reflect past stock price and trading volume information, it also reflects all public information, and it also reflects private information. So the implication is, since all information is reflected in stock price, insider information will not help investors to earn higher return. So insider trading will not be the markets. So if the market is strong form efficient, in our example, the fourth investor 4 cannot beat investor 1 in the stock markets. So let's summarize the implications of efficient market in the efficient markets. So in an efficient market, investors should buy and hold a stock index. Investors should not attempt to beat the markets, and investors do not need to find over and undervalued stocks because those stocks do not exist. And investors should not buy and sell stocks very frequently because that will incur a lot of trading fees. And the next question we want to ask is why we care about market efficiency. Apparently, market efficiency affects investors' trading strategies because, for example, if the market is weak form efficient, that means technical analysis is useless. So as an investor, it's useless for you to really study past stock and trading volume information. And market efficiency also affects firms' behavior. So in the efficient market, It's useless for the firm to try to disclose some false information to cheat investors. And market efficiency will also affect investors' participation in the stock market, and this will affect firms' ability to get financing from the stock markets. So are stock market really efficient? Remember, we have three forms of market efficiency. We have weak form market efficiency, we have semi-strong form market efficiency, and we have the strong form market efficiency. And generally, the evidence suggests weak form efficiency because, in general, technical analysts, they cannot beat the markets. However, there are some exceptions. For example, we have this January effect. January effect means that stocks earn a higher return in the month of January. So as an investor, you can buy the stock at the end of December and hold it for 1 month in January and sell it at the end of January. You can earn a higher return in the month of January. And this is inconsistent with the weak form efficiency. For semi-strong form market efficiency, there are a lot of anomalies going on against this semi-strong form efficiency. For example, we have this size effect. Size effect means the stocks of smaller firms earn a higher risk-adjusted return compared to the stocks of large companies. And this is inconsistent with the semi-strong form market efficiency. And also, we have another anomaly called the earnings announcement effect. Look at this graph. According to this graph, if a firm announces a good earning at time 0, the stock price of the firm will go up at time 0 and keep going up for about 90 days. And so the cumulative average excess return is keep increasing after time 0 when the firm announced their positive earnings. And this is inconsistent with the semi-strong form market efficiency. And for strong form market efficiency, we know there are a lot of insider trading. And insider trading are profitable, but it's illegal in US. And the Security Exchange Commission, they investigate and prosecute anybody that is involved in insider trading. And on the website of Security Exchange Commission, they listed some cases they investigated in the past few years. If you are interested, you can go to their website and look into those cases. And that's it. Thank you for watching.